Welcome to the Future of Work podcast. My name is Frank Cottle, and today I'll be your host. In this episode, we explore the fast-paced evolution of flexible workspaces and their impact on commercial real estate with Will Sandford, Director of Coworking at Yardi. Will discusses the growing demand for coworking solutions, the rise of enterprise clients in flexible office spaces, and how data is reshaping real estate strategy. We also unpack Yardi's long-term investment in the coworking sector and what it means for the future of office space. As coworking continues to expand, could flexible offices become the new standard of businesses of all sizes? Join us and find out. Will, welcome to the Future Work Podcast. It's really great to have you on here and great to see you on Zoom after meeting you in Phoenix a couple weeks ago.
Yeah, thanks, Frank. It's nice to, it's nice to have met you. It's not as nice to be back in Zoom land. It'd be better to be doing it in person, but I'm glad we can connect.
No, it's great. Say, you have such a tremendous background, the combination of WeWork, Yardi, Envoy, so many important elements that relate to the future of work. You're working for Yardi now in a very important role. Tell us, Yardi supported the commercial real estate industry for decades and decades. I think I first ran into Yardi in '86 when I was in the property business. So forever you guys have been around. How do you see, or how does Yardi see the opportunity in co-working today, a flexible office in today's market, and how does that relate to the future of work in your view?
Yeah, good question. And like you said, Yardi has been in the commercial real estate segment supporting operators across all types of real estate for a long time. And I think what brought them to their investment in co-working today is the story of adjacencies. There's been decades long of, working with a customer, understanding their needs, and then, understanding the adjacent opportunities to that. And I think co-working for Yardi, and one of the reasons that I jumped on board here to help accelerate what they're doing in the co-working and flex space is the story of co-working's adjacency to office, who is Yardi's core customer. We all know that office has been struggling and that, co-working and flexible office has been bubbling up as this nascent segment within it for a long time. But we've been invested in this space since, I'd say meaningfully since 2017 as an adjacency to what we heard from our commercial customers, the large institutional investors and owner operators.
By invested, you mean through Yardi Cube as opposed to directly with WeWork, correct?
Correct. Yes. In 2017, we bought One Systems, which was rebuilt and now branded as Yardi Cube, which is our space management co-working operation system. So yes, we've been invested in that. We have a product in the market, but that investment was very much driven by the co-working segment's growth as an adjacency to what we heard from our commercial investment management and owner-operator customers on the traditional office side.
It's funny. Since probably about 2015, we've been saying that there are no such thing as an occupier anymore, that there are only travelers.
I think it's a fair way.
And I think that your adjacency issue, as we look at the changes in the way people are working, whether they were forced by the pandemic or just the battle for talent caused all sorts of changes going on, certainly in the tech industry. We see these things going on, and Yardi must have had a tremendous amount of, even without Cube, but with Cube especially on the flex side, tremendous amount of data that helped them to make this decision. What were you seeing in that data?
Yeah, it's a good point. We have notoriously always been quiet on aggregating and anonymizing data and putting it out into the market, but it does sit there. I would say it's a combination of watching the traditional indicators that everyone else read, right? Dropping occupancy, less utilization, particularly with the growth of I'd say like more Internet of Things tools between Wi-Fi, occupancy sensors, etc. Watching those indicators leading into everything shutting down in the pandemic was a leading indicator that it wasn't going to come back in the way it was.
Exactly.
So we think that the writing was on the wall there. I mean, I think this has been well played out across a lot of people have talked this maybe to them over the last 4 or 5 years, but the leading indicators were there, and I'd say like they were the data indicators that led us to do that. And the other, I guess confirmation that we needed was the anecdotal evidence from operators once they started talking, more and more with their, call it travelers in their buildings when they tried to convince them to come back, because we obviously work very closely with them, but they talk an infinite amount more with their occupiers, travelers.
Sure.
And understanding that the way that they focus and the way that they talk about how they use space has fundamentally changed, started to validate those data points that existed before everyone went home.
I think we've seen an exponential growth. You mentioned the flex sector as a nascent industry, and I think you're right. But boy, all capital letters these days. The growth of that industry within itself, not comparing it to all commercial space overall, has been in the 10 to 12, 15% year over year since about 2013 or 14. I'm going to guess, not guess. I'll make that statement. And
No.
faster than the adaptation of the PC in the 90s, faster than the adaptation of the smartphones in the early 2000s, and it's been year over year for a decade now. So it may be a nascent industry in education of the public, but it is growing phenomenally right now. And how do you see that as relating to the total market size today? And let's call it at 2 to 3% of all office space.
Yep.
This is where you all think it will be going.
Yeah, it's a great question, and one that everyone seems to have wildly different answers on, right? I saw that there was I believe it was the KPMG CEO survey saying that 80% of CEOs believe that everyone's going to be fully back in office. And on the other hand, you have an Avison Young survey of occupiers, travelers, that says that 30% of office stock is going to be flex. So, you still have this like dichotomy of opinion in the market, but the only thing that doesn't lie is the data about how space is being used. So you're absolutely right. We're seeing strong year-on-year growth numbers of the growth of like flexible office product across a variety of forms in the market. As of today, we have a really strong data team that's tracking the inventory in the market on a daily basis, and we produce that out to the market monthly. Today, we're tracking around 7,100 US co-working and flex office facilities that make up around 127.5 million square feet. And every month that we update that, there are more and more of them. And
we track about 8,500.
okay,
So I completely agree with you. We could
somewhat in
argue
the ballpark.
back and forth, but that it's close enough.
Yeah,
And I can remember, boy, I'm dating myself now. I can remember when it was less than 500. So, it really has grown. And I think what's grown along with it, we talk about dots on the map. That's
Mhm.
what and I were just talking about. Those are the dots on the map. But the size of the dots on the map is materially different too. We go back 10, 15, 20 years, your average size was 14, 15, maybe 14 to 18,000 feet.
Yeah,
Today, the dots on the map average size is in the 24 to 30,000 feet, with a lot of dots in the 50 to 100,000 foot range. So
yep.
it's not just the dots that have grown exponentially, but the size of the dots, which equals customer service capacity, which means the revenue of the industry.
Yep.
So that's where it's hugely generative, I think, that we're seeing.
Yeah, and I think that growth of the size of the dot is indicative of like the broader both adoption and shifting, customer profile of the person who's coming in to call it flex. Flex covers all manner of spaces from, on-demand co-working spaces to open co-working to spec suites to whatever it needs to be called by that operator. But that growth of the dot speaks to like a really important trend, which I think is the growth of enterprise in this space. If you're going to have bigger facilities, then you need bigger members to take that down on a longer term basis to prove out your pro forma. And I think we're now seeing that. I mean, people like the Industriouses, WeWorks of the world that hold high caliber, high credit enterprise relationships were some of the first movers to show that they could hold and maintain a long-term multi-location enterprise relationship that formed a meaningful part of their real estate strategy. I heard an interesting term from some of my friends who work directly on the flex occupier side that they don't sell real estate, they sell portfolio insurance. And as that has grown for enterprise occupiers, we've seen the size of those dots become more feasible the larger they get. I think you probably agree that back in 2014-15, if someone opened an 80,000 square foot co-working facility, you'd be scratching your head as to how are you going to make that pencil.
Well, this is embarrassing to say considering what you just mentioned, but between 80 and 90, I built 42 facilities between 35 and 50,000 feet. So I was crazy as a loon back then, I guess.
And how much of that was enterprise then?
10%, maybe. And I'll tell you where the enterprise came from. It was for outplacement from companies that were going through a variety, from the HR departments, took a lot of outplacement space when they were doing layoffs. During that era, the aerospace industry went through a big shakeup for many years. And a lot of the enterprise business started off that way because there was no real tech industry then.
Yep.
If I were to name the big tech companies of the early 80s, none of them exist today. Or few, but, like IBM, of course. But, it's just so different. And I think the first big centers that were built consistently were built by Regis in the dot-com era. And the driver, again, was the dot-com tech driver. It was a true demand for big team spaces. And when the dot-com bombed, that space got re-scrambled.
Yep.
A lot of that space. And now it seems to be happening organically. There's no single driver aside from common sense overall. There was an interesting, I don't know if you remember Sprint, the telephone company. Sprint in the early 90s, I'm trying to pull my memory back here, in the early 90s had about 185 facilities just for themselves, all flex telecommuting centers, and they were pretty big, but we'll call them 20,000 foot average, just for themselves. And they were at that time the largest single operator in the proverbial industry, and it was 100% enterprise. They learned then how well it worked. Unfortunately, their telecom didn't work, and so they are no longer really with us in the same way.
Yeah.
And they've kind of migrated. But what do you think the biggest challenge facing the flex office segment is today? And how do you think the market participants, the property companies, the service companies like Yardi Cube, the operators, and most importantly, the customer, how do you think they can solve whatever challenges you might bring up?
Yeah, and that's a very broad and meaningful question, but I think it comes down to like two beliefs that we have around the flex segment, and they are that there should be flex everywhere, meaning that whatever that meeting of geographic and socioeconomic drivers are that are forcing people to use more flexible office setups, they should be everywhere, right? We've seen the growth of like suburban co-working. We've seen them, near power centers. We've seen the growth of retail co-working, etc. So, there needs to be a form of flex everywhere, and the fit out of that and the size of that needs to represent the the service that it is delivering to that customer in that market. So that's the meeting of the geographic and socioeconomic drivers. So one is flex everywhere, and the second is flex anywhere, and that's really an access problem. So like if there is options in all of these markets, is there the ability for the right consumer to access that inventory without knowing about it first? So between these two things that we believe in, like one in it is going to be ubiquitous and everywhere, serving a different purpose in each place, and the other that everyone should have access to all of it, you start to see that there's a marketplace problem. So to answer your question directly, like what is the biggest challenge for the market right now? We talked up front about growth. It is organically growing. There are more operators and investors coming into the market, albeit not as fast as we would like, but they're entering the market. So we don't have a growth problem, but we need to see it in the right areas to service all types of customers with the right type of inventory. And then we need those consumers to be able to access it. So the biggest challenge is the efficiency of the marketplace.
I agree with that. And that efficiency of all marketplaces is built around communications in some ways and getting the proverbial word out. And um, if I were an operator today and I were to get into an elevator with somebody and they were to say to me, "Oh gosh, Frank, nice to meet you. What business are you in?" And I said, "Well, I'm in the flex workspace business." Most of them wouldn't understand what I was talking about.
Yep.
And if I said I was in co-working, some of them go, "I've heard of that,"
Mm-hmm.
but they don't know what it is. And I think that the biggest challenge that we've always had as an industry, and I think we're starting to get on the edge of getting over it. People like Yardi and IWG, Industrious that you mentioned, Convene, hopefully Alliance, um, are getting the word out about the industry, and the economics are becoming strategic to companies, not just occasionally tactical.
Yep.
And the industry applies, as you've well pointed out, not just to smaller entrepreneurial companies or legal accounting professionals, the solopreneur marketplace of the old days, but is now gone global and enterprise. And when major enterprises are saying, oh, 10% of our people, 20% of our people, 100% of our people are going to be out of the office working at a third workplace or a second workplace 1, 2, or 3 days a week, that is a paradigm shift unlike anything real estate has ever seen.
Yep.
There's never been as big a shift as we're potentially faced with. And we're talking about the complete repurposing, not just of buildings in many ways, but of cities and commuting systems and things of that nature as a result of all this.
Yeah.
Where do you see that going?
I completely agree with you. I think it comes back to this concept of, flex will be everywhere, but in a different form. You know well that there is a use case for each type of building, each type of location, and each type of company. And threading the needle of those things to make sure that you deliver the inventory to meet those three needs in the right space and time is critical, right? The near home movement defines one kind of space. The corporate outsourcing
Mhm.
trend defines a different type of space. And then growth space within kind of large corporate assets could be a third, and the list goes on and on for the different types of what could be considered co-working or flex, and they will all look and feel very different, but all of them are on the rise as there's more broad adoption from this enterprise customer. And I think it comes back to it's a flywheel effect, as any marketplace is. Someone might be thinking there is a large manufacturing company down the road from me in a tertiary market, and I want to open a flexible working facility because they have offsites and they have remote teams coming in, and they dominate the residential market in the area, and they might not want to go to their office each day. But we need more success and access points to that kind of inventory to motivate more operators to come into the market. So this kind of like flywheel effect between flex everywhere, in the operators opening more of the right kinds of locations and flex everywhere with all the users being able to access it, is that flywheel that we need to start. And the challenge there is, enterprise is notoriously picky with how they access real estate, which is how kind of flex is being deemed. So, finding the right access points for that enterprise customer so that they can meaningfully engage in a way that they want to, when they want to, in our market, I think is going to be one of the biggest accelerators to, the growth of our total market.
Well, it's funny you say enterprises are terribly picky. I've known many enterprises looking for large space, and they come into a city and they won't move into the city unless they can get a landmark building with their name on it. They basically felt in the past they had to build a cathedral to themselves
Yep.
almost. And I don't know that that did much for their shareholders, candidly, where Flex is going to be radically different to their shareholders in terms of driving benefit. If you look at a typical large enterprise company and say, well, we're going to reduce our in office utilization or requirement by 1 day a week, well, that's 20% reduction in space. Take a 20% reduction in the leasehold debt off the balance sheet of any global Fortune 1000 company relative to, and give them that money back in the form of commercial debt to grow the company, and you'll have an explosion. It's a massive amount of monies that can be created by this new process overall. And I just read an article yesterday regarding office space. It was in Manhattan, and for new permitting processes, that more than 50% of the new permitting processes were for the conversion from commercial to residential space, which means New York is starting to repurpose itself as a city overall. And how far that will go, doesn't matter. But the effects are that large as we see it. It just going to be staggering, I think.
If I can make one comment on that, I mean, I agree with you. There is a huge opportunity for companies to reduce, call it real estate spend, and either move that into flexible benefit programs or return it to employees as part of.
Just balance sheet. It doesn't even have to be spend.
Correct. But I think if companies are thinking about, their biggest focus at the end of the day, yes, it's balance sheet, but when it comes to their people, it's productivity and, employee NPS. So they have to give something back, right? Because, well, up until a little while ago, it was a very competitive market for talent, and will be there again at some stage. But I think there's a little bit of a double standard when it comes to like how companies think about real estate spend. I'm sure for many of your customers over the year, if you'd gone and asked them, how much are you spending on your 500,000 square foot headquarters? How well utilized is that? Do people come in every day of the week? What's your occupancy of your meeting rooms? They would give you probably a dismal number that would speak to a significant overspend in real estate.
Yep.
Asking them to spend a portion of that on kind of access or real estate benefit programs that let people go where they want, they will start to get very tight fisted about redistributing those dollars back into the ecosystem.
Well, they think everybody can work from their house, and they can't.
Yes.
They can't, and there is a respend there, that's for sure. But I think that, and this is a juggling pattern where companies will juggle around until they find the right formula for their individual organization. But overall, it's my belief, at least, that we're going to see a reduction in conventional space and a corresponding increase, a balance, if you will, in highly flexible space. And because flex space is generally provided on a 1 year or less service agreement as opposed to a lease, well, it doesn't ever hit the balance sheet, even if it rolls year over year over year.
Yeah.
And if there is that new battle for talent, which I agree with you, is absolutely coming, it's a very cyclical issue.
Mm-hmm.
Flex allows you to find talent anywhere and use technology. Technology doesn't have a border. So people working in technology have less and less borders as well. And maybe you're even talking about, a complete economic shift, and a re structuring of how people and where people are paid that might balance out global economics a little bit.
Perhaps that would be a good world.
I mean, you never know what's going to happen or how it's going to happen. Right now, it's kind of a scary world, but it has the capacity to go that far, I believe. And I think it will be driven. You made the comment several times. Enterprise.
Yep.
I think enterprise is the big driver for the next wave of material wave of growth in Flex versus the solopreneurs and the smaller companies that had been drivers in the past. How,
Yeah.
how, how do you think that's going to shape out, not just from the real estate use point of view, but in terms of numbers?
Yeah, so I think they are very important for a number of reasons. One is like the obvious one, like the TAM of that market is much higher. Through our marketplace and speaking with other kind of like co-working aggregation partners in the market, the delta between the average value of a booking from a call it enterprise customer that is on a corporate account versus someone who comes through the website and books on their own behalf is around 40%. So that enterprise customer just spends 40% more on average booking. It's either because they bring someone with them, they are being reimbursed a stipend for use of that space, or they're on a corporate account, so they're not price sensitive. So like just from that individual user alone, if we never get another one of them, if we can just move towards enterprise customers, there's 40% more in the market, which generates a certain amount of growth. The second part of it is, a lot of these customers I would deem like sitting behind a dam. So it's funny you mentioned Sprint earlier. One of the first and most meaningful enterprises to move into the flex market, and I'm speaking from my days at WeWork here, was Verizon. For some reason, these telecom companies, they seem stodgy and old, but they have people everywhere performing pretty routine tasks that can be done anywhere. So, they were some of the first to start testing how do we optimize our real estate spend, and they've been doing this for decades.
Oh well, Verizon actually built their own internal co-working centers.
Correct.
So they had a whole group focused just on that. It was inevitable that they would look towards other providers where they couldn't do it themselves or didn't have the critical mass. That makes perfect sense.
Yep.
Makes perfect sense.
And I think they are a great example of leading the way for if a company like Verizon can be so forward thinking when it comes to optimizing their real estate footprint and optimizing the productivity of their workforce. Why couldn't anyone else? Because there's a pervasive argument out there that this is for tech companies that have all the tools, etc. The reality is that those who recognize the value that optimizing their real estate spend by pushing a certain number of their employees and footprint into flex can give them is probably most attractive to the lowest margin businesses. So, it's at the opposite end, and it kind of runs completely counter to this argument of like tech is the one taking up all of flex. Yes, they are first movers, and yes, they were first movers in force, but over time, as the model is proven out economically, I expect we see many more lower margin, lesser known large enterprises moving into this space more meaningfully. And I guess the second part to answer your question of like, what is the impact of enterprise going to be? Number one was they just spend more, 40% on average per booking for space. But secondly, is there's many more of them, and they sit behind this dam, and that dam is their current long-term leases. As they start to re-rationalize their portfolio and give those employees who currently have a real estate spend attributed to them and release them out into the market for a more optimized spend, the size of our market, being the number of users in it who we've agreed are spending more on space, will significantly multiply the size of and value of our market. So I think it's a combination of capturing the high value of that customer and getting more of them into it.
Well, I agree with you on the spend side. Our data is different, but it's positive in the same thing. We recognize about 120% increase in spend, and it's primarily in the difference in services
Yep.
overall, not in rack rate. That's pretty much the market's the market.
Yep.
But in additional services that the enterprise clients actually require because they work in teams more effectively than they work as individuals. Another group that we're seeing a lot of I don't know that you'd really call it enterprise, but the pandemic did a funny thing to the legal services, to the legal industry. A lot of big firms, the partners were working from home, and then they figured, this isn't so bad, and maybe I don't want to be part of a big firm anymore, et cetera, et cetera. So we're seeing a major shift from large law firms reshifting the partners. The partners themselves are breaking out, going solo or smaller, and going into flex space where before it was purely solo. In fact, the largest operator in the industry in the 80s, the late 70s and 80s, was a legal services operator. The AOMI group, Attorney Office Management Inc. So there's a, it's not just the flow is God, it's everywhere. It's like a giant tide. How do you think you guys have been so involved in the commercial real estate side for years? The property sector itself, the large owners of buildings within which all of this is happening, a big percentage of them have to be looking at this right now and saying, I think we should be operating our own flex space. I know Sam Zell back in the 90s and early 2000s at Equity Office Properties, he had 58 facilities in various buildings called Smart Suite. And how many property companies do you see, or do you all think will be saying, "Yeah, I'm not sure I want to rent to Industrious. I think I'm going to run my own center here and make their profit, add it to my yield, and cap it out." Do you think?
I mean, my short answer is most. And I think the smart ones have started to dip their toe into it cautiously. For example, today I'm in a 18,000 square foot co-working facility that's owned and operated by an institutional operator that owns this 1.2 million square foot building. And walking this prior to this conversation, the community team here mentioned that roughly 1/3 of the tenants that long-term lease upstairs in this building have taken space within the co-working facility over the last couple of years for one reason or another. So I think for the institutional operators, it's two things. Like one, they want to control their relationship with their tenant for as long and for as many of those customer needs as possible. And without flex, they can't do that. They need co-working, they need conference room, they need amenity spaces, they need flex suites, they need spec suites. To do that, that will allow them to maintain that customer relationship. And secondly is, they want to dip their toe into this because as the one who's the most, call it capital constrained because of the economics that have been yet to be proven and digested in the commercial real estate space for co-working, they need some proof points that shows that this is both accretive to the long-term customer value that they have with their tenant, as well as accretive to the asset value itself. And without, I think, dipping a toe into that, in an operator capacity, they're not going to be able to do that, prove it out, and finance more of this and control more of that customer relationship.
No, it's interesting. I think that the shift also of the financial asset managers, so the financial institutions that provide a lot of funding for larger projects, their shift from Class A covenants in long term leases to yield is going to drive a lot of change. Uh,
Yes.
I absolutely think that's going to be going on.
To your point earlier, it's very difficult to take that the value of those services that you sold your enterprise customers and get a bank to underwrite that to provide debt on the real estate.
Well,
Yeah, it is a different cash flow.
some jungle math data on that, and one of the reasons Sam Zell was dealing with this, we learned as operators through the years with multiple hundreds of centers that a third of our short-term clients changed annually. There's about a 3-year life cycle of things. Of that third, half of them just disappeared. They went somewhere else. They didn't succeed. Half of them disappeared. The other third, however, took conventional space equal to the entire amount of space that the center occupied.
Yeah.
That one number, that is the most powerful incubator if the landlord or the property company can capture it. And most people want to stay in the same building.
Yeah. Change is hard.
So the change today of operators of working more as partners with the property companies, management contracts, joint ventures, participating leases, as opposed to pure leasehold tenants trying to time the market. Nobody ever wins on that, neither side. I think that shift is going to continue, and the incubation factor could be very, very good for the entire commercial sector, not just the flex portion of it
Yes,
overall.
100%. It drives more, flex availability, which brings you in contact with more customers. It allows you to serve your existing tenants through more of their life cycle, which at the end of the day is what anyone who's owning and operating one of these buildings wants to do. So I think it's a very positive trend. It's one that will motivate much more diversity across like the type of operations that are available to call it like flex or co-working customers, which explains the difference between my 7,100 US number and your 8,500 US number. I mean, the definition of what this,
What it is. Yeah, definition of what it is. Very, very true. No,
yeah,
very true. One last question for you.
sure.
What's Yardi's roadmap for co-working?
Great question. We've built up, and as I mentioned earlier, like we've had a long-term view on the value that co-working is going to have as a segment, as well as the impact that it's going to have on the office market in general. This is a long-term bet that flexible office is going to be the transformation force for office. So, one part of that is, our investment in operator solutions in Yardi Cube. The second is our belief that there needs to be a marketplace to facilitate access to space anywhere. And that for us is Co-working Cafe. And the third is the story of WeWork. We didn't really get to that today, but Anat Yardi is now the majority owner of WeWork, and we do have an investment in them. But the real story behind that, beyond saving what was I think an important brand name for all co-working facilities, right? If that went down, it would not benefit the segment or anyone participating in it. But the real story behind it, is that we built their technology stack, including their enterprise, co-working collaboration and flex space access tool called WeWork Workplace. So through that, we really learned what it was like to facilitate that need from the growing and high value enterprise customer. So, if there can be one of a few stories that we really see in WeWork, it's that they've done a really good job at courting, understanding, and engaging the enterprise customer in the flex space market. And our relationship with them on that side will continue to do that, because we believe that enterprise is one of, if not the most critical component of stepping co-working from where it's at today into that 10% plus contributor or manager of space in the US market. So I'd say between those three things is really where we see our investment in it. And like all things Yardi, we are always a single solution platform, and we spread out across the needs of the users in a segment. So, for co-working, it's operations technology, marketplace access to space, and the engagement of enterprise. And, we're invested in all those three areas. And I think the breadth and the depth of that investment shows that we're definitely here for the long term. We believe in the segment, and we believe in collaboration between all the participants in it. And we hope to facilitate that.
Well, you're definitely committed, and it's great to see because I've known your company for many, many decades, and always appreciated the seriousness of intent on every move that the company has made through the decades. So it's great to see you're committed, and I want to thank you very much for your time here today and sharing what you were able to share with on your own behalf with your experience at Envoy and Yardi and WeWork. And welcome to the industry, and let's build it together.
Thanks, Frank. Appreciate the conversation.
Take care.
If it's impacting the future of work, it's in the Future of Work podcast by allwork.space.